Every Australian dinner party ends the same way. Someone brings up property, someone else says the share market, and then everyone argues for the next 2 hours without a single number between them. Today, we're going to end that argument with real 2026 data, actual return figures, and the hidden costs that completely change the comparison. Because the answer isn't what most Australians think it is. Let's start with the headline numbers because they actually tell a surprising story. Over the past 2 years, the ASX 200 is up a cumulative 30.2%, at a compound annual growth rate of 14.1%. Australian residential property in the capital cities over the same period has risen 20.2% or 9.6% per year compounded. Shares won by a meaningful margin. And shares included dividends in that figure. Property's number is just capital growth before costs. But here's the thing, over just the past 12 months, property has done better. Capital city housing returned 10.6%, including gross rental yield. The ASX 200 returned 5.5%, including dividends. So depending on which window you look through, you get a completely different answer. That's why this debate never ends at dinner parties. The honest answer is that both have delivered 7 to 9% per year over the past decade, when you include income, dividends for shares, rent for property. The difference isn't the headline return. The difference is in the costs, the flexibility, and what those numbers actually mean for your real money. So let's start with what it actually costs to put $100,000 into each. With shares, you go to a broker, CommSec, Self-Wealth, Stake, and you buy $100,000 of VAS or a portfolio of ASX stocks. Brokerage on a $100,000 trade is around $19.95 at Self-Wealth. That's it. You are instantly invested, fully diversified across 300 Australian companies, paying a management fee of 0.07% per year. Your entire transaction cost is under $20. Now let's do the same exercise with property. The national median house price in 2026 sits at around $980,000. A $100,000 deposit gets you into a roughly $500,000 property with a 20% deposit. But here's what that actually costs you before you get the keys. Stamp duty alone on a $500,000 property in New South Wales is approximately $17,000. In Victoria, $21,970. In Queensland, around $8,750. You're paying that upfront in cash before you've earned a single dollar. Then add conveyancing fees, approximately $1,500 to $2,000. Building and pest inspection, $500 to $800. Lender's mortgage insurance. If your deposit is under 20%, that can add $5,000 to $15,000 to your loan, and a loan application fee of $300 to $600. The total upfront cost of buying a $500,000 Australian investment property in 2026, conservatively, around $25,000 to $35,000 before you own it, before you've collected $1 of rent, before anything. With $100,000 in shares, your entry cost was $19.95. Now let's look at the ongoing costs, because this is where property investors often get a nasty surprise. A $500,000 rental property in Australia will typically generate a gross rental yield of around 4.4%. That's about $22,000 per year in rent. But the actual net yield, after costs, is a very different story. Council rates, $1,500 to $2,000 per year. Water rates, $800 to $1,200. Landlord insurance, $1,000 to $1,500. Property management fees, typically 7 to 10% of rent, which is $1,540 to $2,200 per year. Maintenance and repairs, realistically $2,000 to $4,000 per year for an established property. And strata levies, if it's an apartment, add another $2,000 to $5,000. Add those up and you're spending $8,840 to $15,900 per year. on a property that generates $22,000 in gross rent. Your net rental yield drops to somewhere between 1.5% and 3%. On a $500,000 asset, that's $7,500 to $15,000 per year in actual income before income tax. Compare that to $100,000 in VARs, generating a grossed-up yield of 5.71%, that's $5,710 per year in dividends, including franking credits, with zero ongoing costs beyond a 0.07% management fee of $70 per year. The share portfolio clears $5,640 net. The property? It depends entirely on how much maintenance that specific property needs. Then there's leverage, and this is the argument property investors always bring up. And they're right to. If you put $100,000 into shares, you have $100,000 working for you. If you put $100,000 as a deposit on a $500,000 property, you have $500,000 in an asset working for you. That's 5 times the leverage. When property grows at 9.6% per year, you're earning that on $500,000, not just your $100,000. On paper, that's a 48% return on your $100,000 deposit in a single year of 9.6% growth. Nothing in the share market comes close to that when it works, and that's why property investors are so evangelical about it. But leverage is a double-edged sword. When property values fall, and they do fall, as anyone who owned property in Melbourne between 2017 and 2019 knows, your $100,000 deposit can get wiped out much faster than a $100,000 share portfolio falling the same percentage. And there's one more thing leverage does that almost nobody includes in the comparison: interest. A $400,000 investment loan at the current average investor mortgage rate of around 6.5% costs $26,000 per year in interest. That comes directly off your return. Add it to your annual holding costs and a significant percentage of years, your investment property is cash flow negative, meaning you're writing a check every month for the privilege of owning it. Now let's talk about the 2026 policy changes that fundamentally change the property investment equation in Australia. From July 2027, the federal government is removing the 50% capital gains tax discount for new property purchases. Instead, it'll be replaced by an inflation-adjusted indexation system combined with a new minimum 30% tax rate on gains. This is a massive change. For investors who've relied on the CGT discount as a key part of their property return, this significantly reduces after-tax returns on any property purchased after the cutoff. Negative gearing changes also kick in from July 2027 for new purchases. Rental losses can no longer be offset against personal salary income for established properties. Existing properties are grandfathered, but it means the tax math for new property investors buying established homes is about to change fundamentally. None of these changes affect shares. Franking credits remain intact. The CGT discount on shares remains as is for existing investors. The shift in the tax treatment is clearly moving in shares' favor heading into the second half of this decade. So where does $100,000 actually grow faster? If you're putting $100,000 directly into each cash into ASX shares versus cash into property without leverage, shares win on net returns, costs, and flexibility. Lower entry costs, lower ongoing costs, higher liquidity, and now improving relative tax treatment. If you're using property's leverage, putting $100,000 as a deposit on a $500,000 property, you can still generate superior capital gains in a rising market. But you're taking on significantly more risk, committing to ongoing holding costs, and betting on continued capital city price growth in a market that many analysts currently consider overvalued by 20 to 40%. The honest answer is this: shares are better than most Australians think, and property is more expensive than most Australians realize. And for most people starting out, a $100,000 portfolio of VAS growing quietly in the background, no tenants, no repairs, no stamp duty compounds at a pace that quietly outperforms the property story you keep hearing at dinner parties. As always, this is educational content, not financial advice. Your situation is different from the person next to you, and a conversation with a licensed financial advisor is always worth the investment before you commit to either path. If this helped you think more clearly about the stocks versus property debate, hit subscribe. Next week, we're looking at 5 things Australians are still spending money on that are quietly draining their wealth, and why most people don't even notice. See you then.